The number one predictor of ESG scores broadly is size. If you're a big firm, you just have more resources, right? You hire an investor relations team to keep an eye on your ESG rating. And actually, if you think about it, hiring someone just to, put makeup, there's a term people say, put makeup on a pig, right? Just to try to dress it up a little bit, that may not be a very good use of their time and resources, right? So that itself may be a misallocation.
Hello and welcome to Green Shift, where we try to make sense of sustainability. I'm your host, David Austin, and I'm joined by my co-hosts, Dr. Victor Nian, founding co-chairman of the Center for Strategic Energy and Resources, CSER, and Dini Sandis, CSER's Senior Vice President for Partnerships and Development. Joining us today is Ben Charoenwong, an Associate Professor of Finance at INSEAD. His research operates at the intersection of finance, data science, and law, with a particular focus on corporate governance, financial regulation, and sustainable finance. And we are very excited because Professor Charoenwong's work is solidly focused on some of the most pressing issues affecting the shift to a green economy, namely the effectiveness of ESG initiatives, the challenges of mandatory disclosure, and the real-world impact of political risks on corporate behavior. Welcome, Professor Charoenwong.
Hi, thank you. Thank you for having me. And thank you so much for the kind introduction. Makes my research agenda seem much more impressive than how I would put it, which is just focusing on the minutia of policy implementation. But I'm sure we'll get a bit more into that. It's a pleasure to be here.
Well, thank you so much. And, we're glad you're focusing on the minutia because that means we don't have to, and we can talk to you and get your input on all that. And we want to kind of go over the foundational concepts for the audience of ESG, or environmental, social, and governance, and what that means and what you've discovered. But to set the stage, could you start and just give us the Finance 101 on what we truly mean by sustainable finance today?
Yeah, so if you think about it, this really, the question goes back to the heart of why does a company exist, right? And what's the goal of a corporation? If we look back 200 years, the corporation was created because a bunch of people wanted to get together to produce something, right? And that thing resulted in jobs, resulted in output, resulted in more money. And in a world where economic development, right, was at the forefront, there's a lot of focus on that. And of course, setting up, capitalistic societies kind of supercharged that. And then what we ended up having was also a lot of spillovers, right? So I think where we are in sustainable finance today is really trying to ask this question of how can we tackle these spillovers, right? So we're talking about sustainability in terms of communities, sustainability in terms of natural resources, right? So economics studies scarce resources, right? Scarce resource being labor, capital, increasingly also more focus on carbon, right? That is, you have a stock of kind of emission capability, right, or capacity in the world. And if you start breaching it, you're going to, cause irreversible damage, right? That's going to end up affecting us in the long run. So when we fast forward to today, where are we today, right? So it's all about, can finance change the world, right? In some sense, by subsidizing or punishing certain activities, can we align individuals who are acting in their own self-interest most of the time? Can we align them somehow to be aligned with society, right? And I think the definition is fairly broad. And so this is part of why, my research agenda goes into the implementation and some of the details about how does one actually go about aligning those incentives. And importantly, what can go wrong, right, if the design is not careful, right? So we'll get into that a little bit. But I think overall, sustainable finance is growing. There's a huge amount of assets out there that are what we would call permanent capital. So you can think about this as being in sovereign wealth funds, endowments, pensions. Here in Singapore, family offices increasingly, right, taking this kind of 100-year view of capital management. And in the long run, everything is financial, right? So if you're trying to invest in a company that pollutes, but in 100 years, if your kids can't breathe, right, it's going to destroy the value of your capital as well. So I think increasingly, the term sustainable finance becomes more synonymous with long-term views, long-term investments.
That's a very good definition. Yeah, the idea of permanent capital is a term I haven't heard used much, but definitely having that long-term view is is really what it's all about. I mean, when sustainability, we want to be here for the long term. And I know that ESG can cover so many different things, but of course, we are really focused on that carbon kind of element. That's a pressing one. We all think that that's the most important one that has to be dealt with at the moment because it affects everything else. But this ESG labeled funds that are out there and they're growing so fast. But from your perspective, is it actually working for the market to reprice the climate risk, or is it a green bubble that's existing or has existed?
Yeah, so you know, I think there's a little bit of tension because conceptually, it's really hard for finance to cause a change in anything without changing prices, right? So it really becomes, how do I allocate capital by quote, quote, getting the price right, right? So in some sense, we're taking a stance that if there are no players that care enough about this, or they're not well educated about it, or governments are not helping to enforce a kind of tax or change in the price somehow, right, that we're going to get the inappropriate allocation of capital, right? So we have now more ESG funds coming out, and there's now more subsidies from the government, right, to try to entice investments in those areas to stimulate these industries that have a positive externality. That is, you create jobs, you create output, and you also assist in the energy transition, right, towards more sustainable resources. So that we'll call this kind of sectors of strategic use, right? So governments are trying to guide capital, but at the same time, investors themselves, private investors, non-government investors, increasingly are showing a preference for it. Right now, the question becomes, from an investment perspective, if I have more preference for green stocks, does that push returns up, or does it actually push returns down? Right? Because financial markets actually, at its core, it's a pain distribution mechanism, right? And so if you don't like something, you don't pay for it. And so someone else who will pay for it buys it at a lower price, gets a higher return. So if all of us like more green investments and it's only a preference, right, then you would actually expect average returns on green investments to fall, right? But increasingly, actually, we have more and more evidence that green investment is not just a preference. There may be some component of that, but there's also a component of true risk. That is, there's something called carbon risk, right? So if your company has high carbon risk, it's much more at risk of government policy, which we'll talk about later. So that's kind of transition risk, but it's also more at risk on the changing climate itself, right? You can think about this as impact on agriculture, farming, and so on. So I think there's a little bit of conceptual tension among financial economists thinking about this. The body of evidence is piling up. So we have documented carbon premiums, in tail risks in equity markets, at least in the United States, where the markets are pretty big and liquid. And so we also have more evidence of these big fund flows into green investments, actually moving stock prices kind of in the direction to lower their cost of capital, meanwhile actually shifting up their prices, at least in the short term, right? How this will play out in terms of long-term risk and average returns, I think is to be seen. But like the thing I want to highlight here is it's hard for financial markets to function, right, without clarity from public policy, where that's going to actually be the backstop of everything.
Yes, and that's something that both Dini and Victor know a lot about, making sure that the public policy is harmonized with the goals.
We would definitely like to go more into the green investment and how the politics affect that. And I know that's part of your research. We know that you've surveyed 150 countries, political elections. Could you perhaps summarize a little bit on that, the impact on politics on the green investment?
Yeah, so maybe before we get there, kind of let me state the big problem statement in sustainable finance. Probably one of the most fundamental problems, that is one of measurement. Like, can we actually agree what is green, right? And is it going to be scope 1, scope 2, scope 3? I see Victor laughing because it's something that I'm sure plagues a lot of people, right? And when you talk to green investors who have some preference, you can ask them, all right, how green do you want? How many tons of carbon will you own? Right? Or, what score do you want? What grade do you want? And having spoken to some of these investors, they themselves have a very hard time articulating that. Right? And they just tell me, well, the greener the better. I was okay, but can you change average returns? No, no, no. I want you to keep the same returns or better with lower risk, right? And then with more green. It's like, okay, so let's think about what this kind of green measurement is, right? So I think it's fairly unambiguous if we say, look, let's do scope 1 emissions, right? So you're going to throw out your oil and gas and so on. But increasingly, people have also relied not just on these periodic measurements, but also stuff related more to event-based. For example, there's a big pollution incident, right? Or we discovered, this company was burning down rainforests in order to build a new factory. So almost more like a scandal-driven kind of way to measure it. So I think we can agree, Deepwater Horizon, if you end up kind of just emptying a lot of oil into the ocean, that's like a fairly unambiguously negative thing. So I kind of start there, right? So let's say, look, we can't agree on scope 1, 2, 3. Let's maybe agree, like, let's not poison marine life unnecessarily because we're not careful, right? Let's not, burn stuff down and kill people. So we can start there as a point of agreement. But then the next question becomes, these scandals themselves are not random. They don't just, oops, I just kind of made a mistake and then there's a scandal. But this is actually like ingrained as part of the company's policies, right? Deepwater Horizon was kind of the big event people paid attention to. But of course, in the investigation, you realize they had been cutting corners throughout the entire process, right? So it's actually like a symptom of something that's deeper than that. And the point we wanted to make with the research that Dini mentioned was part of this scandal thing is driven by the press, right? And the press does not allocate its attention randomly, right? So generally, they would pay attention more, right, whenever a company is actually working with maybe a foreign nation that may not be viewed positively, not viewed as a friend. And so in some sense, this whole attention that people pay towards these scandals and the measurement of these environmental problems may actually be political, right? So the research that we have, again, getting back to this heart of the importance of public policy, right? I think we agree that a big chunk of green risk is going to be in the hands of the government, right? The government has to have some political will to say there's going to be now a price on carbon. There's going to be a market for trading, right? You're no longer allowed to poison the waters. Here's the list of chemicals that's banned, right? And so there's certainly a role of government to create a taxonomy for this, right? And I know in the EU, they have this beautiful 400 to 800 page tomb, right, that you can go through to classify different types of green and brown activity. But also, the relationship between nations is important, right? So in our research paper, we're studying American firms, but they're contracting with all kinds of other firms, right? So all over the world. So I know, globalization is not a hot topic right now, but, humanity overall has gained tremendously from international trade, right? And supply chains have become very efficient over time. And what we were looking at is what happens, say, if you are a liberal sitting in California and a place where you're sourcing your supply switches to become authoritarian, right? Like, say, hardcore right wing. And what we end up seeing is actually that those managers of those companies now view that foreign supplier inside the very ultra conservative country as more risky, right? And so what they tend to do is they start to cut their imports, right? And on the flip side, the companies that do not cut their imports end up getting more green scandals. It's like, if Brazil, right, under Bolsonaro, there suddenly you have more journalists maybe looking at, hey, Walmart was sourcing a lot of stuff from Brazil. Bolsonaro's, we don't like him. We're liberal here. We're kind of politically misaligned. And so let's focus on, what's going on there. And oh, look at that. Your Walmart supplier was actually poisoning the rivers. So we're going to write an article. So that's kind of the mechanism that we have in mind. We've spoken to certain journalists to kind of get their opinion on how they decide coverage, right? But the punchline here being is, if we're measuring it this way, attention is not random, right? And so it's not a surprise that you're going to get stuff that ends up being very kind of geopolitically charged.
I mean, it's interesting discussion whenever it comes to taxonomy, and then in the context of carbon space, right? I mean, there is CBAM, the cross border adjustment mechanism, and then people kind of say, if you kind of look at where European and American people are getting their supplies, it is from the carbon intensive countries. So it is inevitable because that's where the most sophisticated and most mature supply chain is. And now we're saying that, okay, these guys, although they may be cost competitive, although they might be sophisticated, although they may be able to supply 80% of our livestock, no, they're carbon intensive, so we can't just buy from them. And in the end, if they don't decarbonize, what we do is, we need to slam a carbon tax to make sure that everybody is now on the level playing field, so that it's not because of cost alone that is driving up the competition against or for the different countries. And now that our domestic suppliers who has lower carbon might actually have a chance to supply to the domestic market. So in a way, bringing the competition on par with those that couldn't really meet the cost competitiveness. So then the conspiracy theory starts to arise to say, okay, so who is this carbon tax designed for? What's really the true intention? Is it really for decarbonization, or is it because it's some just outright protectionism?
Right. Yeah, that's a great point. And that's exactly what interests me the most in this space, right? I think we're all aligned on the goals, but like at every level, there's self-interest, right? There's self-interest of a government to kind of win votes and protect domestic employment, right? There's self-interest in terms of, corruption, right? Of course, in different countries to varying degrees. And then as an economist, we also think a little bit about, like, are you affecting the ability of other countries to develop, right? So I think you brought up a great point, which is, is Indonesia competitive globally because of its cheap labor, or because also there's no enforcement of these other types of policies, and so you can burn a lot of plastic, right, and cut down rainforests. And what ends up happening is, if you have just one region or one country, right, say the EU, say, all right, let's focus on being green, there actually ends up creating incentive, right, to push that production out, right, to other places that are not. And so if from a perspective of economic development and cost competition, right, there's some sense of a race to the bottom, right? So like, I think, governments need to, like, this was really the goal of the Paris Accords, right, to try to get on a similar footing, right, such that we're going to agree, like, here's the rule of the game, right, that let's not undercut each other by throwing out green standards, emission standards, right, and let's not stop enforcing the stuff, and just say, okay, this is a cost humanity will pay, and then we'll try to do something to make up for it, right? Maybe invest abroad, right, to kind of help them leapfrog their technology and so on. But as we're seeing now, right, where we are in the political climate now, it's also super easy to step back, right? And then it's this kind of alliance is really enforced by norms, so far at least, not by military might, right, but by norms and standards. But you could see it's also kind of fragile, right? All it takes is a big, one player to come and say, you know what, no, we're not going to do that anymore. America first, right? Something like that, right? And you can see that everyone starts to step out, because then if they're not, why should we, right? And then you kind of get this very unfortunate unraveling. And so, yeah, but I think that also highlights this point, right? Like, a lot of the green is so tied to policy, right? And you need to have coordination, right? If not, this kind of cross-jurisdiction, different measurements, different taxonomies, different rules, that generally is huge problem. So, that's why, when Dini invited me here, I thought that's a great opportunity, because you really need to highlight the cross jurisdictions coming together, if not globally, then at least regionally, right? To have like a coherent block.
What do you want business people and investors to take away from what you've told us already?
Yeah, that's a great question. So I'd say that, at its heart, managing sustainability is a risk management problem. but at the same time, it can be flipped and viewed as a potential for comparative advantage, right? So a company may differentiate its product through having better supply chains, having more sustainable outputs, and so on, right? In that sense, you would go to your investors and you would say, our product, right, is designed to be, eco-friendly, and we will appeal to the conscious consumer, right? And as a consequence, that will propagate through into our cash flows. So that's kind of one pitch I think that companies can make. But again, a lot of this is also tied to what are the overall taxes, right? Tariffs and carbon taxes that you're going to have to encounter along the way in the supply chain. Business people are incredible and they're smart, right? And they respond to incentives. So, as someone who also teaches in a business school, right? Like the smart managers are responding very strategically to incentives, right? And so you kind of need the clear rule of the game to operate in order to make the optimal decision. Like, I don't want to end up pontificating whether or not it's a race to the bottom globally, right? Because actually the evidence in our data actually shows like there's a lot of shocks all over the world, right? You have governments changing, policies changing all the time, and companies are just trying to optimize their supply chain in terms of cost, in terms of risk, right? There is kind of a implication then that some companies, right, that may not be beholden to short-term investors, right, could take a more strategic long-term view. So that's where, in Asia in particular, you have things like family-owned firms, where inherently a lot of their decisions on corporate governance, hiring, and production tend to be somewhat longer horizon, right, than some public companies. So to me, the interest becomes, what's the role of the financial market to help guide and allocate this capital, right? And if the public financial market is such that you're then subject to the short-term pressure, right, that can induce people to forego, what's going to happen 100 years from now so that I can focus this quarter for my paycheck. That's part of kind of the incentive alignment problem, right? So I would say, implication for business leaders is just to think about what's your structure, right? If you're a majority owner of a company, think about whether your other shareholders are going to think the same way as you, right? And if not, then do you need to do like a management buyout, change who will actually make the decisions here, right? But it's this issue with horizon and this issue with incentives, I think, is like very fundamental.
Yeah, thank you so much, Prof. Ben. And honest truth is, I think companies are under a lot of pressure to show short-term results to investors. So when you say we have to, make financial markets maybe rewards those who think long-term, how would that look like? I give an example, like in Indonesia right now, we are seeing a lot of costs in the green investment because we just changed our government and investors are very, very cautious. So in that sense, what do we need to do then?
Yeah, so I would say financial markets are very good, but because of things like spillovers, there's also some role for financial regulation, right? To me, things like disclosure is important, right? So there's a tremendous body of evidence that if you're just forced to disclose stuff and you have to be audited, right? And if you don't disclose well, you have to be punished, right? The disclosure must bite. But if you have to disclose, the market can better make sense of the data, right? You reduce information asymmetry, you could increase liquidity in the trading of the stock, right? And it actually opens the scope for managers to differentiate themselves, right? So then you can say, look, we're going to disclose that our scope 1, 2, and 3 are much lower, right? Our cost is higher, but that's like part of our edge. This is a product that we offer. And you let kind of the financial market react to that and impound in information. I do some work on looking at alternative data, right? So that is data from satellites, as well as things like music, what are people searching? And it turns out in Southeast Asia, at least, one of the most popular use cases for alternative data is actually in the ESG space. I think that goes to Victor's point, actually, right? That some of these countries they don't have as much government mandated. And so the market is trying to go get some information, right? But there has to be some level of consistency, right? So I think this kind of push towards disclosure is an interesting policy tool. So the United States, right, Security Exchange Commission just mandated climate disclosure as well. There, of course, there's some pushback, right? What is the role of regulator to try to do climate? It's like, no, it's not trying to do climate. It's just saying what is your risk, right? To just describe, right? So, following that kind of more standard framework already, I think, equips the market to try to figure it out, right? Information production is costly, right? But when I learn something about my company or your company, it actually also can, change the way that the financial markets are able to allocate capital. So to me, you want to use the financial market as a tool, right? This goes back to Friedrich von Hayek, which is 1945 in a seminal work called The Use of Knowledge in Society, right? And his whole argument is we need markets because prices are great at aggregating information, right? But in a world with externalities, you do require changes in the rules so that the market will reflect that information, right? And so I think, thinking about improving disclosure is kind of a low-hanging fruit. Again, not without cost, right? So in the US, when they mandated Scope 1 disclosure, what firms do is you just carve out. So this is research by Janet Gow at Georgetown. What firms do is they would find the plants that pollute the most, carve them out, divest them, call them a different firm, and then recontract with them, right? And so you don't actually change anything, but hey, my Scope 1 disclosure did go down. So that's why I emphasize the minutia a little bit, right? Like, what are we going to define as green or not green, right? And you have to trade off the cost of measurement together with some of these unintended effects. Yeah, Victor?
Yeah, I think so. That's exactly your point, Ben. The financial institutions now probably need to take the lead. If really the policies and regulations are lagging behind, somebody has to be, I wouldn't say take charge, but somebody has to stay in front to say that, you know what, we're going to take responsibility. And because you guys are taking money from us and you want financing from us, and so you need to do what is right. And of course, it's very difficult to define what is right, but we can still start, from what you just mentioned, try to relinquish your responsibility by setting up joint ventures and, hey, you know what, you can do that, but there's no financing from us. So you can do whatever you want. You'll be penalized for, the consequences. And, of course, then the other side of it is that then the firm may start to say, hey, you know what, this bank ABC is not going to give me any money, but then I go to bank D or bank E. So they will still be happy to finance my situation out. So then again, it's like, you start to see different camps, right, in the ESG space. So some people say the blue or the brown is somewhat greenish if done right. And then the green people will say, hey, this is just all right, not correct. And we're just definitely not going to be a part of it. So then that also creates a discrepancy in transition where you see the European people or the European firms be seen as a golden standard, and which just simply doesn't work when it comes to Southeast Asia. So I think, that's where it really is your point. The financial institutions needs to play a role. But then the question is, how can they help? I think that's the most critical question.
Yeah, I think if the framework for if I told you company A has been cutting down rainforests and, in effect driving certain animals extinct, right? Impact on blah, blah, biodiversity, people, pollution, they need to be punished, right? So then the question is, what does the punishment look like, right? So as Dini said, one punishment may be I reveal this information to the market, and then their stock price tanks. Okay, that's kind of quite a natural punishment. Then the question is, why would their stock price tank, right? One is because you're anticipating a heavy-handed kind of government penalty. The other is, well, now I've revealed something about this firm's poor governance that's going to reflect bad cash flow somehow in the future. And I think they're not unrelated. So you can see the role of government, I think, is manifold, right? You have on the one hand imposing things like carbon taxes, which I think most economists have agreed is a very reasonable way to do it, or cap and trade. Okay, not without issues and implementation challenges, right? But kind of conceptually seems reasonable. And then kind of moving towards leveraging other institutions, right? Like financial markets. And then there you can think about disclosure. And then at the end, it's kind of, in addition to carbon taxes, you know, straight up property rights and enforcement, right? So some of my most interesting papers in this space have been just thinking about, most places have a reasonable law, but not every place in the world enforces it. And the problem is sometimes when you have that law, but it doesn't get enforced consistently, right? That can be worse than no law, right? Because if there's no law, there's kind of like, we don't really know, let's just figure our thing out. But when you do have the rule in place, what you're going to have is maybe those who are connected say, don't worry, we will get enforced. And then a bunch of others are watching out for the law. And so you then create this uncertain playing field, which I think is a huge problem, right? And so at the heart, like, what is the role of rule of law? Actually, in some of our research, what we found was that when the political ideology switches and it kind of goes against your firm, right, that effect is actually amplified by the rule of law. How do we interpret that? We interpret it as countries with better rule of law, better institutions generally, right, are more effective in taking ideas to create policy, right? So I think we can read that twofold. One is, if we want to help with the transition, countries with good rule of law will kind of be the leaders in this space in trying to build coalitions and taking the first couple moves. But the flip side is also, when there's no rule of law, it's so hard to really do any changes, right? And again, financial markets, to the extent that there is some kind of market imperfection, you know, if the government says you have to disclose, you know, but, you know, no one's going to punish me, so whatever, like, why should we do it, right? And it just becomes this kind of greenwashing at the government level, which will propagate down. And so it's, in some sense, I think tackling this problem is challenging, and it's a chain, right? It's only as strong as the weakest link. And so for the companies to behave, you really need like a fairly strong enforcement coming in. Yeah. So, I mean, you know, we could discuss a bit how we would think emerging markets may do that, but that's kind of, you know, the podcast may become many more hours long.
Absolutely. I am very passionate about emerging markets. But Professor Ben, since you are already touching on the greenwashing, perhaps we should, again, like what David did at the beginning, go a little bit to the greenwashing 101. What does that mean? What does it look like?
Yeah. So what is the issue or concern with greenwashing? It is, I want to appear to be a green company without changing any of my operations. So it wasn't costly for me to change. It doesn't really affect anything in terms of impact on carbon, right, or my carbon intensity, but I get this rubber stamp, right? So, and this is kind of what I was getting at a little bit just now, which is, this may be worse than nothing, right? Because if some market participants are using it as like a positive signal, right? Greenwashing implies I'm just going to try to get that positive signal without doing the work. And it's interesting because we have a trouble even defining, right? Do we do scope 1, 2, or 3? But we do have investors who care, right? Like this kind of, at the beginning, we're talking a little bit about this permanent capital piece, right? So increasingly we have investors who care, but they themselves have trouble defining it. And companies themselves, you know, are trying to figure out also how do they change their rating. And, you know, they're getting feedback from the market as well about what their peers are doing, how the industry is doing, how their own firm is doing. And it's kind of interesting because just like there's a market for financial products, there's a market for widgets, there's also a market for data, right? And so there's a huge problem and challenge in that if we look at credit rating agencies across different agencies, the correlation of credit ratings is like 0.9. So like we can generally agree between Moody's, Fitch, and S&P, which companies are less likely to default, which are more likely to default. The correlation in terms of ESG or green carbon ratings is something more like 0.5 to 0.7. Right. So what that means is there's kind of just enough noise in there that, you know, if your grade is 82, according to this provider, maybe I can get another provider and get my rating up. And not to mention, some of the rating, or a lot of the rating actually, is based off of policy or just check the box type stuff without careful checks of whether or not things are implemented. right? And so, it's different than like measuring your carbon intensity. I think we can generally agree, like measuring that is kind of challenging, but we kind of know how to do it. But unfortunately, a lot of the ratings themselves impound all these like hundreds of other variables, which are only based off of check the box type stuff. And what that ends up correlating with is whether or not this firm has a large investor relations department. So the number one predictor of ESG scores broadly is size. If you're a big firm, you just have more resources, right? You hire an investor relations team to like keep an eye on your ESG rating. And so that's a challenge. So I think there, I'm like advocating for simpler, cleaner, like let's just agree scope 1, 2, and 3. Like let's focus just on those, right? And let's not look at other variables that can be confounded by size and waste. And actually, if you think about it, hiring someone just to, put makeup, there's a term people say, put makeup on a pig, right? Just to try to dress it up a little bit. That may not be a very good use of their time and resources, right? So that itself may be a misallocation.
Yeah, go ahead, David.
Oh no, I mean, I love the lipstick on a pig idiom, and that is, I guess, what all critics of greenwashing are basically saying is that companies, they put on a good show, they have nice ads, they have nice investor relations, but what are they really doing? And thanks for kind of breaking that down for us. I know you also have a bit of prescriptions of how you would deal with this going forward, and you have kind of like a think tank model that you wanted to share. Can you tell us that and give us sort of a roadmap of how you would deal with this?
If we look back at our conversation, one of the key motifs across the different kind of related topics was the role for coordination, right? That, no entity kind of lives in its own silo and operates in its own silo. They're like interdependent. And in particular, I keep highlighting the role of policymakers, right? So government has a very distinct and strong role. Some of the concerns actually in sustainable finance is whether or not sustainable finance itself may crowd out the government in some sense. If your government's not going to solve this, maybe this pension fund should solve it. And so I think the dialogue between businesses, investors who are helping to allocate capital, and the government, they have to be in dialogue with each other, right? And so if you say, look, 80% of my investors demand information about climate, right? Then the actual regulators themselves have more of a justification to say, all right, let's then put in, right, a consistent template, right, for thinking about climate disclosure. And so I think there's a little bit of coordination there. Certainly, I think that's been the trend in the market. The market wants more information. You learn a lot from a firm's climate management. When policies change, and if you have a good management in the company, they should be adjusting their operations as well. And you should see that, right, in some of the scope 1 emissions or 3 emissions based on their supply chain allocations and so on. So I'd say, there has to be awareness. Financial markets move quite fast, right? But investors are becoming increasingly aware. Managers themselves need to feel like some burden to try to take this into account from their investors, right? At the end of the day, that's the role of capital, right? So capital comes in, they demand change, right? Then you're going to have firms will start to share more information. And then I think the government actually has a key role in coordinating that to say, let's then shift from a low information equilibrium to a higher information equilibrium by thinking about more consistent disclosure across different regimes. So investors are better able to manage, the information flow from different markets, different countries, and stakeholders.
Yeah, Prof. Ben, we've talked, and thank you so much for all that. We've talked about the very important role of policymakers. We also talk about markets and the financial products. What about customer sentiment? I know it's a little bit off topic here, but we also see a lot, I think, impact on customer sentiment. So would you two perhaps touch on that as well?
Yeah, that's a great question. And increasingly, I think there's more evidence that consumers, right, and everyday people themselves, as they become more informed and aware, they start to become much more discerning in their own consumption bundle, right? There's great research coming out from the National University of Singapore, studying this and elsewhere. But, I'll be honest, I think I'll say something that may sound weird coming from a finance professor. My whole job is to focus on finance, but I would say, like, if we can educate consumers, okay, we may not need so much burden on the financial side, right? In some sense, kind of finance trying to come in and save the world is definitely not the first best option, right? The first best option is consumers themselves care, right? They will pay more for greener products because they care about their future and their children, right? That turns out, if you just care about your children, that's enough to get people to become much more long-term in how they consume and live their life and generate carbon. So I think that's really closer to the first best option, right? So how can you get people to be more aware? And that will propagate down, right? Again, it's a whole supply chain, right? So you have consumers will be willing to pay more for green products. Companies, again, smart business owners will figure it out, offer those products, right? And then the ones who fake it, right? You have an incentive to actually differentiate more. Right. And so then the ones who fake it will get punished, and the ones who are truly doing it will get rewarded. And the investors are happy because that generates better returns. Right. So kind of you have this nice all around system. But the question becomes, people say it's the chicken or the egg. Right. And of course, for those of us who believe in evolution, it's definitely the egg. Right. The egg came from something that looked less like a chicken and more like a dinosaur. Right. And so the question is, what is the egg? Right. Is it the government policy, or can it be induced by maybe foreign sovereign wealth funds that care about this? I think you can kind of go country by country, and I think it depends. I think countries where there's political will, the government will be the one to initiate because the people start to demand it. Right. That's kind of this self-fulfilling cycle thing. But I think for emerging markets where there's less response or focus on that, then there's role for large pools of capital to come and kind of say, look, I would love to invest in Indonesia, right? If you called the Indonesian government and said, I want to put in $10 billion because I think that's the next engine of growth in the world. But I need to know if you guys are going to pollute the waters. And so I would demand more disclosure, right? The government may say, all right, well, it's 20 billion. So let's think about trying to do something about it, right? So that's where I think emerging markets in Southeast Asia, I would kind of emphasize the role of this kind of permanent capital, large pools of capital, especially from foreign nations, in being able to kickstart some of this. So, again, not the first best way to save the world, but maybe, finance can help Southeast Asia at least get up to the global standards of green disclosure and green finance.
One question I have, and please correct me if I'm wrong. You talk about sovereign wealth fund family offices. How about banks? At least from my own personal research, speaking to several banks, it doesn't seem that they are keen to invest in green companies, probably due to risk. What's your opinion on that? And is there anything we can do to push that?
Yeah, that's an interesting point. Given the various crises we've experienced with banks, after every crisis, we come in and we regulate the crap out of banks, right? To the point where banks now are so risk averse, they end up cutting a lot of that economic activity. A lot of the lending that they used to do, now they just no longer do because it's going to carry a lot of capital charges. So that's a good question. And thinking about going forward, whose role is it to allocate capital? In many emerging markets, banks have been the very big part of that capital supply. But banks' mindset is not a growth mindset. They do not take equity in companies. They cannot grow with companies. That implies they cannot generate the same big nonlinear returns, right, that you're getting in some of these venture capital or private equity or even public equity. And part of that is due to the financial regulation, but also part of that is due to their entire capital structure. So the way they're focusing now, right, because of the framework that we've imposed on them, is very much about mitigating losses. They're focusing on minimizing catastrophic risk. They can't benefit as much from a lot of the growth in, some of the transition work, but they will respond very aggressively if you say like, hey, your lending portfolio is at risk of a tsunami because of rising seawaters. They will then respond very fast, right? So that they would require a different framework. So it comes down to capital structure. Is it a question of equity enticing the upside, or is it a question about liability, debt based, where we're going to kind of talk about risk, big catastrophic capital destruction, physical risk, or transition risk, right? You're going to have a policy that's coming soon that's going to make some of these businesses obsolete, right? And kind of lose out on their business model. So I think, the role of government will be slightly different there. Generally, and this is somewhat personal opinion, but it's also grounded in theory, that you want to align incentives on the growth side so that people can focus on building new stuff rather than focusing just on loss mitigation, right? And unfortunately, that's why, I didn't mention first banks are the way to go. I think they're kind of there to mitigate the really catastrophic stuff, and they'll respond to that. But I think for a lot of things that we need, like new industries, right, new technology development, banks are not incentivized to finance new tech investment, right? That's going to kind of help with our power demands. There, you're going to need something much more like growth capital, private equity, public equity, right? So and that's where I think sovereign wealth funds, family offices, even retail investors, right, can be harnessed to actually finance that pocket.
Thank you so much, Ruben. And given the time that we have, maybe if David, if you're agreeable with me, we ask Professor Ben to give some concluding remarks.
Yes, I think for the closing question, you can tell us, what at this point makes you optimistic, if you have any optimism, and what might keep you up at night, and just kind of give us your view looking forward.
Yeah, so we'll start with the big picture. Okay, the stuff that keeps me up at night is part of the prisoner's dilemma of different countries starting to step down parts of their commitment to energy transition, and solely because of geopolitics or domestic political pressure. So that's kind of stuff that is somewhat heartbreaking for me. But at the same time, with the new innovations, with a more educated workforce globally, I'm quite optimistic that we can innovate our way towards the transition, even if the incentives are imperfectly aligned, right? I think the first best, we all get together, we have these rules, we all enforce the rules globally at the same standard, and then businesses will react. But even when some do and some don't, I still have hope that in the places where incentives are aligned, their population is incentivized enough to kind of come up with new innovations, be it green concrete, right, carbon capture technology, that's going to enable us to actually avoid some of the catastrophes that may be ahead of us. And talking to people in that space is exciting, right? And to Dini's point, that I think is definitely a growth space, right? So they're coming in and they're thinking, wow, this can replace all of these other kind of brown processes, all right? And this will become our edge, and we can do it cheaply, and we'll figure out. So I am quite excited about that. And, hence, some of my work thinking about both financial regulation from freeing up capital markets and how do we allocate capital better, right? There's a lot of people with ideas. How do we give the resources, allocate the resources to them? So I heard this term recently, right? It's not an abundance problem. There's a lot of resources. It's an allocation problem, right? And the mechanism that allocates the capital, to me, are the financial markets, right? And so where policy falls short, we hope that financial markets can do its job to allocate capital appropriately. Being in Singapore is quite exciting, being a financial hub, being a hub to all of Southeast Asia, right, to a large fraction of the world's population. And I'm sure there are exciting times ahead on various fronts.
Very good. Well, thank you so much for sharing all that with us and sharing your valuable time. We really enjoyed it. I really appreciate it. And I hope maybe you can come back and talk to us again sometime.
Oh, I love that. It's been a pleasure. Thank you so much for having me.